Hello and welcome everyone to the week ahead commodity report for the 10th to the 14th of June, presented by myself, Phil Carr, at the Gold and Silver Club. So first of all, what do you need to know as we go into next week? Gold prices broke out significantly last week, up 3% for the week and also up 1% on Friday, breaking out to 14-month highs, levels not seen since April of 2018, as a sharp slowdown in US jobs on Friday off the back of the non-farm payroll data sent the dollar spinning lower on growing expectations that the Federal Reserve would cut interest rates this year. Now, of course, we have the FOMC statement now, which is going to be coming up on Wednesday, the 19th of June, and you want to look out for that for an explosive trade opportunities. That's Wednesday, the 19th of June. Meanwhile, oil prices, they rose nearly 3% on Friday, climbing further from 5-month lows hit the previous week, which we discussed in detail after the proposed tariffs on Mexico. However, we have seen support come back into the oil market on Thursday and Friday after Saudi Arabia said OPEC was close to agreeing an extension to the output production cuts beyond June of this year. And with that, we did see oil springboard higher into the close on Friday. Hedge funds and money managers, they have cut their net long positions in US crude oil futures positions in the latest week. However, they have also raised again their net long positions in COMEX gold in the latest week, which of course has helped gold to break out to those 14-month highs, clearing above 1,345 US dollars per ounce. So with that, we'll move over to the charts and we'll talk you through our forecasts and key levels as we go into next week. Firstly, let's move over to WTI crude oil, which of course has now started to build up some momentum into the close on Friday after the comments from OPEC with regard to increasing production cuts till later on in the year. This is definitely something to watch out for in the markets. The OPEC meeting is now scheduled to be at the beginning of July. Often the narratives and the rhetoric in the lead up to the OPEC meeting tend to give oil a bit of a boost, particularly if we've seen a significant sell-off, and we certainly saw that over the month of May with over a 14% decline to the downside for US oil. The key level that I suggested last week that you really want to look out for where support could come in would be between $52 per barrel down to $50 per barrel. That 50 level would tend to be a magnetized level where often the price would just get to a major level before it then turns. That's essentially what we saw here midweek after oil inventories data, where we saw another build, the largest build since 2017. After the sell-off on Wednesday, we did start to see that support come into the market on Thursday. As a result, on Friday, we've actually bought in prior to non-farm payrolls, banked a quick 70 pips on the trade, and then we re-entered again after non-farm payrolls on Friday, banking again 110 points profit, and we're letting the remainder of the trade run over the weekend with the stop loss move to entry price. So essentially just on Friday, we banked 180 points on this rebound and springboard higher going into the weekend with the stop loss protected, and we're running in profit on the trade as we go into next week. So with that said, we've got a bullish bias now as we're going into next week. You can see that V-shaped reversal pattern, which I discussed to look out for in last week's report, that if we did see evidence of buying coming back in at that swing low around the $50 per barrel handle, that you then want to look at all of this support which came in January of 2019. If we see evidence of buying coming at that level, married up with fundamentals, which is very important, you want to look at the market sentiment, trade flow, research-driven trading, where we were seeing all that rhetoric and narratives coming out of OPEC with respect to extending their output cuts. And you've also seen more optimism about the trade war tensions as well, with negotiations going on again with China and also Mexico too. This has all provided positive sentiment for oil to rally here on Friday. We started to see that immediately come into the market off the back of comments from Saudi Arabia on Friday regarding OPEC, and that was very straightforward trade opportunity based on research-driven trading, and we also married up with a very key level of support. So what are we looking at here with oil as we go into next week? Well, we definitely have this V-shaped reversal pattern in development. You wanted to be fairly fast to get onto that move on Friday here because we've already started to build up momentum to the upside. So what I would suggest, I would look at the potential you might see some pullbacks within a V-shaped reversal pattern as we go into the beginning of next week. So any pullbacks here which then get supported, they might then provide opportunities to actually buy back in to a potential retracement which then springboards higher. Bear in mind that at the moment it is Wednesdays when we tend to see the most bearish moves on oil right now, mainly due to that oil inventories build. So you want to protect your trades when we get closer to that Wednesday's oil inventories. You've also got Tuesday later on in the session, the API data as well. Outside of that, if we do pick up momentum to the upside here for oil, I could certainly see the potential, seeing as we're at 54 US dollars per barrel, to then start to build up momentum here, take the price back up towards the next major level, which would be 55 US dollars per barrel. If we do then start to build up momentum beyond that, I would then look out for the potential to rally up to that 56 US dollar per barrel handle if we continue to see momentum to the upside here develop as we go into next week. You do have quite a lot of previous support here, which may turn into some resistance between 54 to 56, but those would really be the next key levels that I would look at if we then start to develop into a V-shaped reversal pattern and then ultimately make a move back towards that 55 to 56 US dollar per barrel handle. So that's what I'm looking at with respect to oil as we go into next week. As I mentioned, I am long this going into next week with a stop loss protected, and I'm looking at more upside here, but I'm watching very closely all of the news feeds. OPEC meeting will be really important, which is going to be occurring at the beginning of July now. It's been pushed out from the end of June. It's now going to occur at the beginning of July, and look out for all of the oil inventory data points that will be coming out in the next few days. Of course, as always, it's very important to have real-time news when you are trading the oil market. A lot of market participants seemed a bit confused about the fact that oil was rallying on Friday. One of the major catalysts for that was comments from Saudi Arabia regarding the potential to extend output cuts. That was immediately perceived as a bullish event for the market, and also the overall optimism around trade deals too. So that's what we're looking at with oil as we go into next week. I will actually just give you the quick flip side of that as well. Let's say this is a failed move. It is possible it could be a failed move, in which case our stop is protected. We have a risk-free trade running on this at the moment with partial profits banked. But if we were to see a rollover in price, what I would look at would be the potential to look out for evidence at the lower end of this channel again. So basically 50 to 50 US dollars per barrel is quite a significant level of support at the moment. So let's say we really do pull back again towards the lower end of that range. I would look for evidence of buyers coming back in at that level. Okay, that's the major zone which at the moment is providing a lot of support, and buyers will be looking at potential to pick up long positions at that area. I also mentioned previously that normally the month of June from a seasonal point of view does tend to be a bullish month for oil, and as a result of moving into the summer driving season later on into June and into July, often fuel consumption does tend to pick up, demand picks up. That can also have a positive impact on oil prices. Now moving over to gold, what an explosive move that we saw last week, and also on the non-farm payrolls data as well. So you can see here on gold, we have now broken out to the highest level since April of 2018, broken above the swing highs here. We've just tapped that 1348 level, didn't quite get to 1,350 US dollars per ounce before then starting to retrace, closing Friday at 1,340 US dollars. So looking at the price action here as we go into next week, you can see certainly we've tapped that double top at the moment, and we want to see whether gold is going to be able to follow through. Do note, in terms of the overall positions from retail traders versus the money managers, hedge funds and money managers have continued to accumulate their net long positions as we have been reporting each week with you, whereas retail traders have continued to sell into all of these rallies that we've seen throughout the last 2 or 3 weeks here since we're at right the lower end of this channel. You had a lot of retail traders the previous week who were selling into gold once it broke down, broke back below the 1280 zone, getting trapped in the wrong side of that trade, and essentially hedge funds and money managers, institutional traders, they have continued to build their long positions in gold, whereas retail traders have been selling into every rally. So it's just worth bearing in mind there are a lot of traders at the moment, retail traders looking to sell at these levels right now, whereas money managers have continued to buy into gold. So you just want to bear in mind that retracements might be shallow. We've also got the FOMC statement as we go into not next week but the following week, where we might start to see, of course, that rhetoric and narrative in the market really start to focus on the potential for the Federal Reserve to reduce and cut interest rates, and that will be positive for gold prices. So the takeaway there is there are a lot of traders trying to sell this move right now at the highs here from gold. From a stop loss point of view, the risk reward will be just putting your stop loss above the recent swing high and then looking for a reversal, targeting back to key levels of support and so forth with some sort of V-shaped reversal pattern, sell off to the downside. That's what a lot of traders are looking at the moment from a technical point of view for gold. So it's just worth bearing that in mind, that maybe you want to look at a bit of a contrarian view here, that overall funds keep buying these dips at the moment on gold, if we do have shallow retracements, it is possible we could then break above the swing highs and really start to make a move back towards the next major layers here, which would be 1350, 1355, if this is just a shallow retracement. And that's really what we need to see evidence of as we go into next week, whether this move is going to continue to follow through in the lead up to the FOMC statement, which is just a week and a half away, or whether 1350 is going to be significant resistance, whether that is going to provide a double top here, and whether we're going to see then gold start to roll over and we see profit taking to the downside. So that's really what you want to keep an eye on next week. If we do start to break back below Friday's lows, that's where you could then have confirmation that we're starting to break down and we could start to see gold give back some of the recent momentum to the upside. But if that doesn't happen, and if gold continues to drive higher, we could certainly see some explosive moves on gold, especially if it clears back above that 1350 handle. So absolutely, the date for the diary will be that FOMC statement, which is going to be on the 19th of June. You definitely don't want to miss out on that trade opportunity. Now, moving over to silver, you can see very clearly where we've now had a breakout from that downward trending channel, which has been in play since March. And it is interesting because hedge funds and money managers, they have again reduced their net long positions in silver in the latest week. So really, we want to see whether we're going to just continue to see this follow through to the upside, break above Friday's highs here, which reside at the moment at $15.13, and whether on the higher time frames we're really going to start to make a move back towards the previous swing highs, which reside around the 15.32 level. Just note that silver closed right below $15 per ounce on Friday. You can in fact see here very clearly that it is a much larger bull flag formation on higher time frames here. So on the weekly chart, we have finally had a breakout of this channel. We've also had quite strong rejection last week, and we're really waiting to see confirmation of that, whether we were going to see silver follow through to the upside and break out, or whether it was going to roll over and break back down within a bear flag formation. So what we've observed here on silver over the latest week is that we saw the gold silver ratio break out to the highest level in 20 years the previous week. The gold silver ratio has started to decline and roll over, and we've also seen silver start to catch up with some of the price action we've seen here in gold in the latest week. In fact, platinum was a great trade for us last week, banking in the early part of the week 270 points profit on the remainder of this trade. We've mentioned platinum many times before, that platinum sub $800 has been a really optimal time to buy into this market, several times going back to December of 2018, January of 2019, February of 2019, and also at the end of May, after platinum sold off by more than 11% over May and then found support right at the end of May and then springboarded high at the beginning of June. This is a trade that we executed in the latest week and banked profits on the breakout in the early part of the week. That was really fast profits. Platinum had the biggest one-day move here that we'd seen in 2 months, and we capitalized on that whole move to the upside. And this is really the importance of research-driven trading. It's very important to understand the cycles in the market, overall market sentiment, the trade flow that we're seeing, marrying that up with seasonal data, and that will really help you to generate trade ideas that give you an edge in the market. And that's what you need, an edge in these markets. The market conditions at the moment are just really optimal to take advantage of these really explosive moves right now. We've seen that on platinum in the latest week, certainly on crude oil, and now gold with the breakout that we've seen here to the highest levels since April of 2018. So I certainly hope that you are capitalizing on this volatility in the market at the moment. So if you would like access to all of that information, very simply, there is an opportunity for you to join us at the Gold and Silver Club. As a member of the Gold and Silver Club, you get access to research-driven trading. Members have access to exclusive live trading room webinars throughout the week. You also have access to real-time trade alerts, real-time trading research and market insights, access to our private members academy membership site, as well as support and one-to-one mentoring. For more information, please just go to www.jointhelivetradingroom.com. The link is also below this report in the description, so just click on the link, make an application, and we will of course get in touch with you ASAP. And do make sure you subscribe to our YouTube channel. That way you're always kept updated with all of the latest commodity reports.